We're down to 8% growth on a 3-month. Cryptocurrencies, Bitcoin, Ether, they have corrected. What we are also focused on is that loss of purchasing power. It fell again to a new low. It doesn't like this loss of purchasing power. I know that this fear that inflation at 7%, which is the CPI right now, on a year-over-year basis, is getting embedded into the system because wages are rising and so forth. And so what we're seeing on the monetary and fiscal front right now is effectively significant tightening already. On the monetary front, we've seen money growth go from 27% at its peak during the coronavirus, the depths of the coronavirus, to 13% recently. But if you look at it a little more closely and in a shorter term time horizon, we're down to 8% growth on a 3-month basis, 6.5% on a 2-month basis. And we believe that money growth will continue to slow quite significantly, especially if the Fed does raise interest rates. Now, we wouldn't be surprised to see the interest rates go up in March. Many people, after today's employment report, are beginning to think that 50 basis points is the number, that the Fed will basically telegraph that it means business and that it's going to head inflation off at the pass. They may do that. And if they do, however, we think the stars are aligning in such a way that they will get the message very quickly that they don't need to do much more. On the innovation front and on market indicators, cryptocurrencies, Bitcoin, Ether, they have corrected with the equity markets. More and more hedge funds are involved in them. So when the market corrects, we do see higher correlations these days, although over a full market cycle, the correlations between crypto assets and any other asset is extremely low, which means for diversification purposes, crypto is a very interesting asset. In our Big Ideas 2022, you will see how we break out crypto. Our understanding is evolving, and we are able to describe it in 3 ways: a money revolution, a financial revolution, and next generation internet or metaverse revolution. What we are also focused on is that loss of purchasing power is feeding through to retail sales. So retail sales in the all-important December month were down 1.9% on the heels of a 0.2% increase in November. With inflation at 0.4, 0.5, 0.6%, those numbers, that retail sales number would, in real terms, taking inflation away, have been down 2.5%, and in November also down. So consumption is falling. You were also focusing on what companies like Facebook and Amazon are saying. Amazon's sales, Amazon reported yesterday, its sales on a year-over-year basis were up only 9%. Now, it was up against a very tough comparison, and I think on a 2-year basis, we've still got solid growth, but still 9% is even lower than the lowest point during the 08-09 crisis, which was 14.5%. True, Amazon is a little bit more mature of a company right now, but 9% I've never seen out of Amazon. And it was facing tough comparisons in the quarters prior to now, and we saw nothing like that 9%. Facebook is suggesting that for many reasons, its sales growth in this quarter will be somewhere in the 3 to 11% range. This is the lowest ever. It's never been in single digits. So Facebook has, we think, some competitive problems, but it did point to weakness in the retail sector, as did Google in its report. So consumption accounts for roughly 2/3, a little more than 2/3 of the U.S. economy. Retail sales are mostly on the good side, so that's about a third of total consumption. The rest is services. So we look to the consumer sentiment surveys to give us a sense of where we're going from here. And if we did get another University of Michigan consumer sentiment survey, and it fell again to a new low, and it's lower than at any time during 2020, during the coronavirus crisis. And it is heading for lows that we haven't seen since the 08-09 crisis. So the consumer doesn't like this loss of purchasing power. We know that the unemployment rate and the employment rate are working in the consumer's favor generally, but and that usually is a prime determinant of how the consumer's feeling. But it's clear loss of purchasing power is top of mind. So let's go to market indicators now. Equities, as you know, they did move to an all-time high, but the internals of the market last year were not good. They were, I think I mentioned on the last In the Know, that the ratio of new lows to new highs was as high as it's been since 1999. And in 1999, it was the value stocks that were hitting new lows as everyone was racing into the internet. In this last year, it has been our kinds of stocks that were hitting new lows as value stocks were hitting all-time highs. And as you know, the right thing to have done during the late 90s, when that ratio behaved that way, was to move away from the new highs into the new lows. And I think the same is true today. And I'll just give you a preview of what may happen here. You know, I was very interested after Ford said that the demand for its F-150 Lightning EV was so much stronger than it expected. Its stock exploded. Now, I want our auto manufacturers to be very successful in the EV space, but to see its stock jump to highs that it had not seen since 2000 is a sense of what I just said. What that move said to me is, oh my goodness, investors don't understand that 97 to 98% of its sales base is gas-powered cars, and we believe that the shift toward electric is accelerating here, oil prices being one reason, but also lower prices being another as battery costs come down. So I found that very interesting in the context of the juxtaposition of the late 90s against today. We're also seeing a lot of confusion in the more mature growth area of innovation. Facebook is facing real competition, and TikTok is of course the reason. And it's also under pressure because Apple is not giving it or allowing it to have as much information about users and has put in place new privacy objectives and rules. So Facebook was one of the stocks hitting all-time highs. Now, I have spoken to some really good value investors, who've been doing this all their lives, and asked them, if interest rates were to move into the 2 to 3% range, let's say as measured by the long-term treasury yield, which parts of the market, given where we are now, would be hit? And the answer that I found most interesting, and that I think we've just seen in Facebook, it would be the more mature growth companies that are facing some competition, and not the super growth companies that are just entering into their exponential growth trajectories. Again, another argument for new growth. Think Amazon early 2000s. If you had put into a dividend discount model Amazon's revenue growth rate for the next 25 years at 20 to 30%, say 25%, which is what happened. Nobody believed it was possible. Then, given the way that the cash flow dynamics would have been projected, you would have bought that stock all day long as a value investor. And of course, the returns would have been phenomenal. We are in that same place with truly emerging growth right now.